Warren Buffett has been squeezing in some last-minute holiday shopping and just earlier this week announced the purchase of not one, but 3 different stocks. This is a little bit surprising for folks because usually there's a significant lag. You could see what Warren Buffett owned as of September 30th or June 30th or March 31st. There's this lag if you're managing over $100 million and you're required to file with the SEC saying this is what I owned as of this period, but there's this window in which you wait before you file. That doesn't hold when you are part of the management, the board of directors, or you own over 10% of the company. In those situations, when you're buying and selling, you need to announce it in a more timely manner. In this case, Warren Buffett's Berkshire Hathaway owns over 10% in these 3 different companies. And so that's the reason why you're getting this very real-time information that Warren Buffett has been buying these 3 stocks in just this past week, which is exciting because you saw a little bit of volatility earlier this week. So this means that Buffett and his lieutenants see value in these 3 companies. So the question is, should these companies be part of your holiday shopping list? So let's dive right in. My name is Daniel. You're watching Unrivaled Investing. And I think before you look at what he's actually been purchasing, it is important to have a little bit of context. The biggest transaction, buying or selling, the biggest transaction this past year from Warren Buffett was selling over $100 billion of Apple stock. And the reason why that's important is because even if you buy, let's say, $500 million in a new position, that's sort of a rounding error relative to the risk off that Berkshire Hathaway has seen with reducing their Apple stake by $100 billion. So that's a significant larger cash position, over $300 billion in cash at Berkshire Hathaway, a lot of dry powder. This is sort of buying around the edges. These are stocking stuffers. This isn't the big gift that everyone goes, wow, this is a game changer. But maybe some folks will find value in it. I suspect part of the reason why Buffett has been selling his Apple stock is the existential risks that more and more folks might turn to their phones and say, hey, the most valuable part is no longer the ecosystem, it's actually the AI. And there, Apple's been noticeably lagging. And so could you have some sort of threat to Apple's pricing power as more and more devices and more consumers lean in on their future AI initiatives versus, hey, this is just a really cool brand and, nice camera. We'll see. That hasn't played out yet, but it is a risk, I believe, that he sees. Plus, you haven't really seen a lot of growth with Apple, and it trades at a premium multiple. So, looking at his purchases, the largest purchase was with Occidental. OXY is the ticker, over $400 million. The price is ranging from 45 to 47. You can see that oil prices, that's what Oxy is strongly tied to, has gone down over the last year. At one point was closer to $90 per barrel. Now it's under $70 per barrel. And the reason why that's interesting is Buffett was previously buying closer to $80 per barrel, and he was buying at $60 per share. And this is the first time that both the price of oil and Oxy shares dipped lower and that he sort of re-upped. And he was buying around $46, even though oil was below 70. So, I'd say this is an indirect call that he expects oil prices to be higher, longer, or at least flat, so not to see a lot of downside from here. I also think that this is a call on Oxy's assets, the long-term production and free cash flow potential that you could see from Oxy. Looking at Oxy in terms of their different assets, they do have this decarbonization venture, and they do have transportation assets and chemical production assets. That said, the vast majority of the value comes from their domestic oil and gas production assets. So it really is tied to the production of oil. And you can see the change in West Texas Intermediate barrel per barrel of crude oil. $1 change is a $240 million in annualized cash flow. So this company, Oxy, is highly levered to the changes in prices of oil. So not surprising to see Oxy sell off when oil sells off. So when oil prices went below $70 per barrel, not surprising that Oxy also went from this 50-60 range to this mid-40s range. Looking at Oxy now, it is a little bit up on the news that Berkshire was buying, trading around $45 billion market cap. Based on their free cash flow and the current price of oil, it's around 6 to 10 times free cash flow. Very wide range, just depending on where you think, oil prices bounce around. If you are in a new paradigm, let's say in a year or two from now, where oil prices are much, much higher, then arguably this would be much cheaper. I look at this and it doesn't scream out to me. I don't like commodity companies. I'll talk about my checklist a little bit later. His second purchase was around $100 million of Sirius XM Holdings. SIRI is the ticker, with prices around $21, $22 per share. In this case, he owns around 30% of the company, with Oxy also owning around 30% of the company. And I did a prior video on what he was buying with Liberty and Sirius. And, if you want to understand the business in greater detail, personally, I just don't like this. I don't like declining, sinking ship type of assets. And you can see so far this year, revenue with Sirius has been shrinking both year to date and in the most recent quarter. Subscriber revenue lower year over year, advertising revenue lower year over year. With Pandora, their music streaming, that was squeaking by a little bit higher, advertising lower year over year. So I just don't like it is the short story, looking at the sales trends and the subscriber trends. That said, what's, Buffett seeing it's that it has a market cap of under $8 billion, and management's goal is to run this as efficiently as possible and squeeze out more free cash flow. Yes, there's a lot of debt, but maybe they could squeeze out $1 billion in free cash flow this year, 1.2 billion next year, and then maybe 1.5 in 2027. And, when you're talking about that versus the sub $8 billion market cap, you're effectively saying, hey, it's somewhere between 5 and 7 times free cash flow. So once again, this dirt cheap multiple. In the first case with Oxy, it's a dirt cheap multiple because you're dealing with the uncertainty of commodity prices. In this case, it's a dirt cheap multiple because the uncertainty of, will this business even be around in 5 to 10 years from now? Will subscriber trends and churn worsen significantly? Because at the end of the day, some people love it. Some people go, I don't see the need to pay for this. I would rather just have YouTube in my car. When I look at these purchases, frankly, I just think about, it would have been better off for Buffett to say, I'm going off of the valuation spectrum. I'm going to follow Phil Fisher and focus more on, let's say, higher quality businesses. Maybe there's more uncertainty about the future trajectory, and just pay a better multiple. And I think shareholders in Berkshire Hathaway and Warren Buffett himself would have been better rewarded, maybe even just buying Google over time or buying Amazon, where, yes, it's a little riskier of a venture, but riskier just based on something like valuation. With Google, you have the uncertainty of, will AI disrupt their search business? But I personally, if I were in that situation of managing $300 billion, I would rather put the capital to work in something like that, a Google or an Amazon, where it's less likely that you see those signs of disruption, versus something like Sirius, where the signs of disruption are already there. It's already a sort of a churning business. So personally, that's where I see the value. You can make a different argument with oil, and maybe, you have a lot of inflation in the years ahead. So let's go through his third purchase real quick. That is Verisign. Before I go through it, first of all, as always, this is not financial advice on this channel. And also a quick plug. Recently, Michael, a premium member of the Unrivaled Investing community, shared, this is a direct quote, "So far, the subscription has paid for itself in 3 months." This follows Venu, another premium member, saying, "Joining your membership has been one of my best investments, both in terms of value and personal growth. If you're looking for compelling ideas, come check out unrivaledinvesting.com. So looking at Berkshire Hathaway and their third purchase in Verisign, VRSN is the ticker. This was around a $45 million purchase. So just for perspective, Oxy was $400 million roughly. Sirius was around $100 million, and Verisign was around $40 million. And it's funny, is my own perspective is I would probably say Verisign, from a perspective of quality, is probably better than the other three, in my opinion. And we'll talk about why in a second. Berkshire owns around 13% of the company, and they're purchasing around $190 a share to, let's say, $196 a share, you can see roughly. And Verisign provides critical internet infrastructure, the registry services for .com and .net. So the way to think about this is, anytime someone wants to register for a .com address, that domain, or the annual renewal, Verisign's getting a cut. It's a beautiful toll booth type of business model on critical internet infrastructure. So I love those recurring revenue monopoly type of businesses. And you could see it in the results. You could see very steady revenue, very steady profits, not a lot of volatility. This is just a beautiful business. And you could see for the last 5 years, significant repurchases and significant free cash flow. And they've even borrowed a little bit money from time to time. So that's the reason why their repurchases have exceeded their free cash flow in some years. And overall, you look at this business going from 700 million in free cash flow to around 900 million in free cash flow now. So it's a reasonable clip, I'd say high single digits. And, it's almost all going back to shareholders via buybacks. And that's what I like to see. The challenge with this business is that arguably the .com, .net new name registrations has been flat to down over the last few years. And you can see how that's sort of been trending by quarter each of the last, few years. And so that does raise the concern of maybe .com, .net just isn't the place to be. And more folks are going to be using something like .ai to register their new venture or their new businesses. So you do have this risk that you are seeing play out with Verisign. However, trading around $19 billion market cap, and generating, let's say 900 million in free cash flow, it's not crazy expensive. It's definitely the much richer valuation than Oxy and Sirius. And this is an example of, I think, one of his lieutenants paying up, saying, hey, I'd rather, own this monopoly type business that trades at 19 times free cash flow versus, and 19 times free cash flow. I think the way you can think about these returns, it's sort of a puzzle, thinking about the different pieces. You have valuation change, you have fundamentals, and you have cash flow. Think about those 3 buckets for Verisign. Even if you don't get any valuation change, better or worse in the years ahead, you're probably still going to get either pricing power or, let's say 5 to high single digit, cash flow growth over time. In theory, unless .com really starts deteriorating. I don't really see that playing out. It's possible though. So that's one angle. So core growth at a reasonable rate, then throw in the buybacks each year, which if it's trading under 20 times free cash flow, that's an incremental 5%, that you can get for shareholders. So shareholders are really talking about a 10 to 15% type of return over time for Verisign before any change in valuation. So, that's, I think, the return framework that they're considering from it, and view it as a lower risk sort of bet versus some other companies. I look at, each of these through my own personal checklists. Like, for example, with Verisign, you don't really have the aligned management. Berkshire is one of the largest shareholders, but it's not like they control the company. I would say it's at a reasonable valuation, not a deeply compelling. Reasonable is, something that I would say it's passable with Verisign. So it's not really passing here. The obvious growth potential, I would say it's okay. It's not really jumping off the page. And, from the others, the no blow up risks, I don't really view their contract to lose the .com or .net registry as, likely to play out. And I view this as a win-win for consumers because consumers benefit from being able to securely and easily access .com and .net websites. So looking at something like this, it's very obvious to me that neither of these 3 bets really fit my own personal investment checklist. And I think that's the importance of recognizing it's okay for other investors to have a different journey. And I think it is important to recognize, Warren Buffett is in a completely different game than you or I. So you at the end of the day need to figure out what's right for you. Maybe you want to just follow and copy along with what Buffett does. Oh, I see he buys Oxy. I'm going to buy Oxy for myself. And maybe that works out. The good chance that it does, especially if you see an uptick in inflation, let's say in the years ahead. Personally, I would rather, for my own personal investment journey, I would rather find situations that are more management owns 30% of the company, 40% of the company, and it still trades at a reasonable valuation, let's say 20 times free cash flow or under. And there's a very obvious path for why it keeps growing at 10% plus in the years ahead. One example that I called out to my subscribers earlier this year was Shift 4 payments, which in full disclosure I owned, and at the time very clearly, fit each of those, criteria. I think I even called it out, Shift 4, indirectly through one of the videos where I called out significant insider buying, because you had the aligned management with Jared Isaacman, buying. Jared Isaacman's the founder of Shift 4 Payments, so he owns 30% of the company, so aligned, plus he was buying shares. Compelling valuation. It was trading around 15 times free cash flow when I called it out to my subscribers. Obvious growth potential. Every single year that they'd been in operations, they had grown either their volumes or revenue by 10% plus. So, and management saying, look, here's our playbook for why we're going to keep doing it in the years ahead, which includes further M&A and expansion internationally. So I felt, based on their track record and what they were saying, that struck me as obvious. The blow-up risks was a little bit more manageable. We're thinking about they did have some debt, and so I wanted to make sure that was taken care of, and management correctly refied it. So I looked at, that's the reason why I made Shift 4 Payments part of my own investment journey earlier this year. It's something where it's very easy for me to see personally, and 15 times free cash flow. Yes, it's not as cheap as, let's say, a Sirius at 6 times, but I think the durability aspect of saying, do I think this business is still around or much bigger 10 years from now, is much easier for me to stomach at, let's say, 15 times free cash flow for something like Shift 4 than 6 times for something like Sirius. If you have a different opinion, I'd absolutely love to hear it in the comments below. Thanks so much for watching Unrivaled Investing, and happy holidays.